when you have price levels that create highs, like this swing high here and this swing high here, they're real close to one another. See that? When you're looking for relative equal highs, here's your secret weapon for it, okay? How do you know it's a high probability relative equal high that's likely to get swept or traded through? How do you know that, ICT? What differentiates that from any other? Okay, it's this. If you have two swing highs, if the one to the left is slightly higher than the right, you have a very, very high probability that they're going to want to take it above there. Just like you see here. We have a high, and then the swing here happens to be just a little bit lower than that one. Here's what's going on. This is called priming, okay? Priming is where you continuously create, inspire, or manipulate the expectations of a large number of investors. And they think, oh, it's going to go through that high. But then there's a lot of folks that don't want to see it go there because they went short. So when the market goes up here and stops and turns down, what that does is it creates a sympathetic sigh. The shorts are relaxing. If the shorts are relaxing, what are they saying? They're saying that this is now what? Resistance. So anyone that takes a new short position, where are they going to think that the safest place to put their stop loss is going to be? Right above these highs. Why can we trust that they're likely to take that relative equal high out? Not that it will that session that you're trading, but it's high probability that this will be swept when the second or the one to the right, that swing high is lower than the one to the left. That frames these two as relatively equal. Okay. Same thing is occurring here. We have this high here, this high here. This one being slightly lower than that one. So when the market went up like this and we had this drop down, what that causes is a sympathetic sigh. What is that causing people? Anyone that went short here, they feel like, okay, that's scary because it almost went to that high where their stop loss would be if they're trying to go short in this area. See that? So what do you think it looks like when we have relative equal lows? What would be a high probability relative equal low that the market is likely to draw down and go below? It would be a low that has a slightly higher low. In common terms, it's referred as a failure swing. Okay, so a failure swing. Now a lot of people say, "Oh, see, he's just reinventing." No, see what you're trying to trade that. That's what a failure swing is. When you're trying to trade long or short on that second pass that doesn't take out the low or take out a previous high. That's selling short a failure swing. Okay. What I'm teaching you is how to identify in price action where the algorithm will refer back to and why. What are the central tenets as to what the algorithm is referring to at a specific time of day, most important. And then it refers back to these because, okay, it sees this high based on time, and then the high prior to that one is here. So it's very simple for the algorithm to call that information as an array and say, okay, this high was at this time, and this high was higher than prior to it. And they're in close proximity. What's the filter? I'm not going to tell you that, but it's not very much in terms of difference between the price. And when you have that element, the market will invariably start marching back to those levels. It does not matter. Listen, folks. It does not matter how many buyers are buying the market to go up there, and how many short sellers. Okay, the proof of it is just look at a depth of market. Look at a ladder. Okay, a dom, not a dome. Okay, I'm so tired of hearing people go. It's not a dome. Do you see an E at the end of that? It's DOM. It's a dom. Okay, depth of market. Look at those orders. There's no imbalances there. There's no imbalances. There's just as many short orders below the market as there is above. But yet the market will still march and march and march and march and go to the beat of the drum that I tell you it does. It reaches to these levels because it's coded to do this. We have relative equal highs here. I don't like to usually do this, but I have to do it for the sake of discussion. So we have these relative equal highs, this high and that high, relative equal high, and we have this area up here. So if the market's going to do what? If it's going to make a punishing move towards the shorts that want to see it drop because the market has dropped early on, 7 o'clock in the morning, okay? And we have all these very clean levels. What did we just do here? We have a low. It was traded down into. It disrupted this little area in here. So it's made this area jagged. Remember I was saying earlier where the market's real smooth over here versus what it was doing down here. Where has the work been done? Meaning, if there is a group of traders that are very cannibalistic and they tend to be more correct than wrong, or if they are the ones that generally make the money more consistently than the ones that don't. In other words, think of like the World Series of Poker. Okay, if you ever watched that, it's really fascinating to see how the long-term players that always find themselves at the final table. They may not win, but they always find their way at the final table. That's experience and that's skill. Well, you can see those things in price action. They're like fingerprints, okay? You can see when the cannibals come in and they devour the pygmies. They go in there and just chew them all up. And it's where the market is made jagged price delivery. Always. It's always like this, folks. It's never not going to be hidden from you, okay? It's always plain sight. So we had these relative equal highs swept here. See that? Case study, bullish breaker to there. So how many candles did it take to do that? You screenshot it. How many handles did it run from the low to that relative equal high being taken out? And once it does that, keep the chart active with it on there, but then just make it very, very light. Well, not that light, make it light. So that way you can still see it, but it doesn't have all of your focus. So that way it allows you to focus on, like, there's a fair value gap here. We traded down into mid gap, which is this wick here. Since price is above it, that makes it a discount array. Consequent encroachment of that trades to it. We want to see it run above this high here. Some of you that are trying to learn how to do this are having a blast with this, because not only am I giving you things to talk about in your own journal of focus, but you're also seeing things unfold over a live chart, and you're watching on your live chart. Okay, so this is not market replay. It's not delayed data. Okay, it's not after the fact talking narrative over a chart. Everything that these asshats leave comments on in my YouTube comment section that you can't see, but I see and getting amused by it. So there's the relative equal highs there too. So now, same thing here. You want to mute that in terms of its importance. And now you want to see, does it have the wherewithal to run aggressively for that 17,820.75? The idea is that you're looking for the smooth areas where the price is so obviously being defended and being presented and being offered for retail-minded trades. See, I don't look at charts. I absolutely don't look at charts and think of what retail pattern here I can use to get in sync with a price run. Look at that beautiful delivery right to that volume imbalance there, which is inside encapsulated in that SIBI. Went right to the high of that. Now, when you're looking at price, you're looking for the obvious, very, very, very smooth relative equal highs or relative equal lows. How do you know which one they're going to go to? How do they know? Well, I'm sorry. How do you know? How can you trust? How do you determine which side of the marketplace it's going to reach for? Because what this is going to do, it gives you the initial building blocks to understanding bias. Oh, you didn't realize we were going there, did you? You didn't realize with all this jawboning, and half of you quit watching because I was talking about things that wasn't interesting. But they're coming back to the channel now, or later on, they'll say, damn, it went right to where he said it was going to go. It did exactly what he said it was going to do again and again. And it's going to do it tomorrow. And it's going to do it Wednesday. And it's going to do it Friday. And it's going to do it next week. And it's going to do it every friggin' week that I want to stay out here and do it live. Okay? That's just the way it works around here. That's the way it is. Because I understand what this thing's doing. And then you want to screenshot that. Okay? So when you're looking at price action, you want to be able to determine what in this whole scheme of price delivery, what does it do in terms of resonating with you? Where would you feel confident? This is the part that a lot of my students skip over. They don't do any work with this part of it. They ignore it. They assume that it has no bearing on them. It doesn't have any basis or placement in them. Okay, because they want some kind of gimmicky little 1, 2, 3, get me in the trade. Where's my stop supposed to be? I only want a one handle stop loss like ICT. I want to be able to do everything perfect right from step one. I don't want to have any adversities. That's not realistic because you're going to have a whole lot of adversities. And you have to invite that. Be comfortable with it because that's where it's going to highlight your shortcomings in your understanding, and it's going to also teach you how to overcome it. If you have the capabilities, I'm not saying you have to, but if you have the ability to look at a 15-second chart, study every level I've outlined here and the logic of why it was going to draw up into that 17,820.75 level. I gave you the bias before we really essentially started today. I explained to you in very, very bland commentary, almost boring really. It didn't seem scientific. I used analogies that I thought were very simplistic. You know, when we're looking at areas that are very smooth, contrast this area up here, how that was very, very smooth. And these, remember these levels over here? I told you this one. In addition, if you weren't looking at that, that's the benefit of looking at 3 time frames. Because if you can frame an idea of why the market's likely to draw to a high or a low or inefficiency that is completely visible on 3 time frames, that means you have 3 time frames telling you, hey, pay attention to me. And if that time frame or those time frames are in agreement with a relative equal high or a inefficiency above the marketplace, that means like something like this right here, or this right here, or this right here. They're all stepping stones. Notice that? They're all stepping stones. Inside the context in your overall narrative that the market was going to go here. When I first started the live session, what's the first line I dropped on the chart? This one. It was based on these 2 highs here. That's all it was. Why did I pick this high? Yes! He got my question. Finally, I've been sitting here the whole time you're talking. Why'd you pick that high? What's the first thing I told you? The algorithm is going to go based on time. I don't care what Mickey Mouse pattern, what Mickey Mouse logic, some romper room theory that just got pulled out of somebody's backside because they want to sell some attention for clicks and views and mentorships. Unless it stems on the basis of time first, it has to be the right time. If it's not the right time of day, it is absolutely not going to work. Period. End of story. Put anybody as the mentor, anybody as the trader. I don't give a fuck. Bad, Michael. Should have never said that. I tried real hard. I almost got through it. Put anybody you want in that list. Whatever they trade, however they trade, it does not work. It will fail. Stick with it long enough, you'll see it will fail more times than it'll work. But why and how is it that every single time I'm sitting down with you, whether it be on a Twitter space where I was calling out the candlesticks individually before they happened, or in a live stream where I'm giving you the logic, explaining to you why it should do it, okay? And then it just simply does it. How's that possible? No ego, Seriously, let's put it aside. I'm not trying to beat my chest here. I really want you, especially if you're a first time viewer here, or maybe you come back, this is your second time watching a live stream because you expected me to do something silly today. How is it? How is it that the market does exactly what I'm saying it's going to do? You ever think about that? How is it possible that this one single person can get it right so often in front of thousands of people when many of them are hoping and praying, please, please, God, let him get it right. I got to go on Twitter and brag about how you messed up today. I got to make a video exposing ICT. I need grocery bill money. Oh, you're so fun to manipulate. All you haters. But 7 o'clock is a very key time. That starts what? The morning session. It matters not that we're trading Forex or futures. The morning session, AM session, starts at 7 o'clock in the morning, New York local time. Okay? So you can have a model that says, I can't be in front of the charts between 8 o'clock and 8:30. And maybe you can't even trade the 9:30 opening bell for indices because you have to get ready for work. Okay, but it just so happens that the time elements in your personal life and geographically location in the world that it allows you and affords you to look at the market between 7 o'clock and say 7:45. Worst case scenario, 7:30. If you're going to work with smaller time frames, you absolutely can use 7 o'clock to 7:30 as a model to do this very exercise. Same thing. So your key times are this: 7 o'clock in the morning to 7:30. In that 30-minute window, you're going to look for relative equal highs and relative equal lows that have happened prior to 7 o'clock. Okay? And you're going to be looking through the time frames of the 1-minute chart, the 5-minute chart, and the 15-minute time. Now, Caleb, you're not expected to do anything else beyond that until I change the depth of what your focus should be. Right now, you're just having 3 charts up. Since the 15-minute time frame is pretty static, you only need to refer to it once in the morning. And then your second chart could be the 5-minute chart. We'll go back. That's what it is right now, 5-minute chart. But then what you're doing is you're watching between 7 o'clock and 7:30, or 8 o'clock to 8:30, or 9 to 9:30 opening bell. You're looking for, where is the market smooth? Smooth. Because still waters invite rocks. Think about that. Remember being a kid walking and you see a pond, it's real smooth. Wow, look at that. It looks like a mirror. You can see the sky's reflection off of it. So smooth. What's the first thing that jumps in your head? I need a rock. For what? Because you can't accept that. Our sinful nature says we have to disrupt that. So you pick up a rock and you want to throw it out there. Why? What's it going to do? It's going to cause ripples. That's exactly why a weak character individual in a relationship will have a beautiful relationship, a wonderful relationship, something smooth. Ain't no drama, no reason for ruckus. And what they got to do? They go out there and they chase some thought. They go to the bar, they pick up some floozy or some silver-tongued fox that says all the right things for her. And you invite that disruption. Well, that's what the market does, folks. It's a dysfunctional family environment. And you have to be the one that says, not today, Satan. Not today. Not today. I know your tricks. I know your snares. I know how you're going to do it. Okay? So, what's the market going to do? Every single session in the morning, you have 3 opportunities. And you don't have to trade in the afternoon. You don't have to trade the London session. You have 3 opportunities in the morning to set the stage for a run that will build, if you don't have any understanding about bias. But when you set up a framework of whatever you're going to study in the morning, if you're going to trade the morning session, your key times, you have to absolutely be in front of the charts between 7 o'clock and 7:30 in the morning, always New York local time. Okay? If you can be in front of the charts by 7 o'clock, this is what you're doing. But if you can't, you do the same thing at 8 o'clock to 8:30. The same thing at 9 to 9:30. Okay? This is your pre-market range. Write that down, because if you don't write it down, you're going to forget. You're going to call it the opening range. It's not the opening range. The opening range is the first 30 minutes after the opening bell. At the New York session, the first 30 minutes after 7 o'clock to 7:30, that is your pre-market range. 7:30 to 8 o'clock is your opening range. Oh, remember I was telling you I could trade every single hourly candle? Now you're starting to think. Your ears are turning, aren't they? Oh, it's fun, isn't it? And obviously the 9 to 9:30, that's your pre-market range. And then post 9:30 to 10 o'clock, that's your opening range. There is no 15-minute opening range. I don't care what anybody tells you. Okay, it's a 30-minute opening range. That's algorithmic. Okay, so what you're doing, and this little range here that's being shown here with this rectangle, what I'm saying is this is essentially that 30-minute interval, whether it be 7 o'clock to 7:30, or 8 o'clock to 8:30, or 9 to 9:30, that pre-market range. In that range, what you're doing is you're looking at this line or beginning of that shaded area would delineate the 7 o'clock or the 8 o'clock or the 9 o'clock, where it begins at that specific top of the hour. And then this would be the range that makes up that first 30 minutes. Now, it's not obviously to scale, but I'm oversimplifying for the purpose of teaching what I'm saying. Prior to that range, anything before or to the left of this, you're looking for equal highs or equal lows. Which side has it? Because that's your bias. It's going to draw to that. How do you know? If you have both, because I heard you, you're thinking it. But what happens if you have a relative equal high here and a relative equal low here? Which one are you going to go for? You wait for the first one to get disrupted, because once that happens, then you work to the other one. That's your bias. So you have to defer and wait. Now, gamblers or live streamers that just want to have people watching and doing anything and not really executing on stream, but after the trade starts moving in their favor, then they'll show, oh, I took a trade here. What good is that? What good is that? That just proves you're not confident in what you're doing. And you're going to show it after it's moved in your favor. Talk about it, explain it, and then do it. I'm going to do that. But today I gave you a clinic on how to determine bias, how it's easy for me and it's easy for you. Whichever one has the relative equal highs or relative equal lows, that's a smooth area. It will be disrupted. Anywhere where you see jagged edges like this down here, see how it went jagged and then ripped higher. What's it telling you? What's it telling you? I'm going to look for buy side liquidity, buy stops. This has been a trap. They engage traders to go short. They're trapped short on a breakout, or they're not trying to take the shorts out of the market yet, and that's why you see all of this in here, a little bit creeping up. This is all balanced. That's why this spike stopped right at the top of the breaker here. Isn't that interesting? Isn't that interesting? I've been talking nonstop. No chance for me to have another ad over, voiceover. It's all live. You watched me do it live. I explained the logic. And now here's the wonderful thing. You have the privilege to go back to your charts and backtest this. And your jaw is going to drop. But anyway, the market trades down to the bullish breaker that I absolutely identified before it hits it. And then goes to the relative equal highs I told you to focus on. And then I gave you this one here. And I told you this imbalance is prior to these relative equal highs being taken. But this was where we were focused on. And look where we're trading at. See that?